What is private debt? And better question is, should dentists consider investing in debt as part of their investment portfolio? I'm Dr. Johnny Walker, aka Dr. Jonathan Withanachi. I'm the host of Walk of Wealth. And in today's video, we're going to break down what is private debt. We're going to talk about the advantages of it. And then we're going to talk about how you can actually implement this strategy in your portfolio. Now, private debt, whatever your preconceived notions are, I think today our goal is to give you a lot of clarity into what it is and how great of an investment it is and why you should absolutely consider it as part of your portfolio. Joining me today to discuss this topic is an absolute expert in the world of private investing. He's a professional fund manager, also a good friend of mine. His name is Mr. B.D. Dwight. Thank you for taking time out of your busy schedule to be here. I know you're a super busy guy. And you've been on our channel before, and you're an absolute welcome guest. You're a wealth of knowledge. I learn from you every time I speak to you. Just for some background information for the viewers, bi-weekly, every 2 weeks, me and BD meet and we talk about investments. We talk about the things that we're seeing in the marketplace. We discuss industry gossip, and it's absolute, we just learn a ton I learn a ton from him. Like every time we speak, I learned about different investment strategies, mindsets. So it's just a wealth of information. And I think we're all very, very excited that he's here joining us and sharing his knowledge with us. So BD, welcome back to the Walk of Wealth channel here.
Thank you, Johnny. Happy to be here. And it's always great to see so much of the parallel, what I do with the tech sector and, which is really where my background is. You're pretty much doing a dentist, which is really spreading financial literacy and really helping other investors determine what are the best strategies that they can build on to really invest their money and build their net worth. So I do appreciate all the things that you do. And we definitely have a lot in common. And
Yeah,
always have fun whenever we meet.
Yeah, absolutely, BD. So BD and I were really drawn to each other because we share a very passionate and very detail-oriented approach to investing. It's something we both take very seriously, and because of that, we've really gotten close. We've gotten very close because of that. All right, BD. So let's get right into the topic here today. Now, let's start with the main question. Now, what is private debt? Like normally, as an investor, like we assume, like I'm a dentist. When it comes to real estate, the first thing I assume is, hey, look, when we buy real estate, we go to a bank. We borrow most of the money from the bank, and then we come up with the rest of the money. And that's the money, that's our down payment. That's what investors put into the deal. And then we expect to get a percentage of the profits of the deal. Now, this is the main thinking about how real estate works, right? But now, BD, the main assumption on this part was the first thing you do is you get a loan from a bank, and then you go and get investor money, right? But now we're going to turn this thing on its head here and say, wait, so you're saying that you don't have to get the money from the bank? You mean there's other ways to do this? So BD, I'll let you get in here. This is where we cue you in. What is private debt?
It's great. So we start with a big picture in terms of debt, and then we'll bolt on the piece for private debt. And if you think about it, when you're ready to acquire a property, let's just say you're buying a single family home investment, very simple. You're going to the bank to get the debt, and the bank asks you for a down payment. That's really the equity piece. But typically the bank puts a lien on the property to basically secure their money. Because remember, their bank is bringing 80% of the capital, you're bringing 20%. So as the current banking sector is right now shifting, where money markets has dried up and interest rates has gone up, it really created an opportunity for investors to play on the debt side. So instead of people going into banks, because banks are taking times to lend and they're really scared about how much they were looking to lend, it created an opportunity for investors and private lenders to actually play in that role. So it's no different whether the debt is coming from a bank or the debt's coming from a private note. It's still secured by a property. Whenever you're taking a mortgage, the bank puts a lien on your house. So what happens if you sell the house? You actually have to pay the bank first, right? Because there's a lien on the property. So similarly, in a private debt, the investors are lending out the money for somebody who is purchasing a particular property. And here we're going to talk about the different ones and the risk associated. But and that money that they're lending is going to put a lien against that property to kind of secure themselves. And then there's a promissory note in the private lending, which is the same thing as you have your monthly mortgage payment on your house, same thing. But now you're actually paying back to the private lender, and that's effectively is the repayment back of the loan. So it's no different than what a loan that you would take on a business or a loan that you take on to buy a property. In private lending, we as investors are lending out the capital to people, that are purchasing property. So that's really what kind of the private lending market. Now, why has it become very interesting? is really the question is when bank lending rates were down at 4% and 5%, private lending always carried a premium. So it was about 7-8%. But when interest rates starts to shoot up, and right now people are getting loans about from the banks at like 7%, private lending rates have actually gone even higher. So now it's about 10, 12, or even goes higher. So when you get to the point where, hey, the double-digit return in lending is starting to get as close as what you get in terms of an equity investment, but it's a much, much lower risk, it really starts to get interesting. So that's why, due to disruption in the lending markets, due to higher interest rates, and due to the high double-digit, returns, annualized return, a private investor should really look into investing into private debt, because they are looking to get a higher level of return at a much lower risk. So typically for us, we're always looking at deploying capital, and we still invest in real estate into the equity side, but we look at a way we can now start to diversify a little bit, take slightly lower risk, and actually deploy capital on the lending side, especially when it's actually returning double digits. So private debt is effectively us as investor putting capital as a collateral against the first lien for somebody who's really going to acquire a specific property.
Very good. Very interesting. I mean, there's a lot of layers to that and a lot of questions that I have from that. But, so private debt, it's you becoming the lender, right? You meaning investors are becoming the lender instead of the bank. And, you said one of the things about it is that you get a lien on the property, right? So you're securing what's owed to you by getting this lien on it, right? Now, this rolls right into it. So now we're acting as a lender. We talk about getting liens. It's a lower risk. That rolls right into what our next thing is, right? So the advantages of it. And you've already touched on a couple of advantages. One of the advantages is that it's lower risk than an equity position. Right. So when what BD was talking about, like usually with the very simplest of capital stack is how the money is used, how you've bought an asset, where that money has come from. And the debt, there's usually debt and there's equity, right? So the lower on the capital stack you are, the more secure you are, the safer the position you are, because that's who gets paid first. So in a debt and equity, debt always gets paid first. So I think what BD's saying there is that it's more secure because the first money coming out of any real estate property, the very first person that's getting any money is going to be on the debt side. And that's why it's a lower risk and a more secure position, is because debt gets paid first. And only after the debt obligations are made in full does equity get any piece of the pie? So I think that's one of the major advantages, and you touched on very well. What would be some other advantages and also we talked this as private debt. This is also another term for this as hard money lending, which a lot of people throw out. So BD, tell me, let's go into some of the other advantages of investing in private debt or hard money lending.
Yeah, and I'll tell you, I mean, it does take a professional to kind of underwrite the debt, right? So we're not typically, as investors, underwrite our own debt. No, we go for professionals that are in the mortgage creating, or basically the debt vehicle creating or no creating business, basically, to really do that. But for us, the benefit as investors, like you said, the yield is basically the interest rate that the borrower is paying us is quite high. And, we're talking double digits, 12%, 13%, 15%. And our money, like you said, is actually lower in the capital stack, meaning, that the debt has to get serviced. Pretty much like in a multifamily, right? You generate all the rents, you pay all the expenses, and the first line item is, hey, you got to service the note. You have to actually pay the debt. So same thing in private lending, you have to service the note, meaning you have to pay the interest rate. So let's say it's 12%, now it's 1% per month. So from you as an investor, you're getting, for example, if the yield note that you're getting on that debt is 12% and it's paid out monthly, you're getting 1% per month. So you're getting your money right away. So when you're looking at it from an IRR perspective, which is the finance way of looking at things, a 12% yield is 12% IRR. So because your money is not really paid out at the end, like in the exit in terms of the appreciation and syndication, it's literally paid out right now. So a 12% note is 12% IRR. So there's definitely an advantage there. It's high IRR. The second one is,
let's touch that. Let's touch on that. Let's expand on that a little bit, BD. I think that's a very important point. So when he says IRR is 12, right? When you're looking at these other equity investments and they're saying, hey, the IRR is going to be 16% over a projected 5-year hold. Now that 16% IRR, it means that that's what you're going to get on average over the 5-year hold per year on an annual basis. But if the income or the cash flow from that property is only projected to be 4%, for example, in an equity deal, like a regular investment where your majority of syndications lie, you are going to be really receiving in your pocket more like 4%, right, of cash flow. So if you invest $100,000, you might get about $4,000 in year one, but you're really waiting for a profit on a sale or on a refinance to really get the chunk of the rest of your profits. So you have to kind of believe that in the future, I'm going to receive the majority of my money. In the beginning, I'm only going to receive a very small amount. Whereas in this private lending situation here, you're getting the money right away. And I don't know if it went over your head. It's 1% a month and is distributed monthly, right? Debt is almost, depending on the terms of it, usually starts getting paid right away, or at least within a very short period of time. So that means if the debt is getting paid through a mortgage payment, then the lender gets paid first. So I think that's a very important point, BD, is that you're getting your money now and you're getting a high cash yield from day one. And I think that's a huge advantage there. So, sorry, BD, to interrupt you. Let's go on to the next point.
Yeah, no, absolutely. I mean, that's absolutely critical. And that's what I said. Private money became more interesting for us as investors as we started hitting double-digit returns. When it was 8%, 7%, it was okay. It was like, okay, but now, I mean, if you can put your money into a CD, which would give you, 4.5 or 5%, versus you can put your money into a private lending, which is, in my opinion, secure enough. You can't say it's as secure as a CD, but it's secure enough because it's really secure about a property. And you can get double-digit return. So you look at your level of return over the risk-free return. Risk-free return as a CD is a 5%. Let's just say your yield return on a private note is 12%. So now your premium that you're getting is 12 minus 5. So now I'm getting a better than I'm taking a little bit of risk, but I'm getting a much higher premium in terms of my return because my note is at 12%. So I'm getting a premium over the risk-free return. So the question comes in is like, how do you take a little bit of risk but get a much higher rate of return?
So you're saying that your risk goes up marginally. I mean, it's relative. The marginal part is relative, but your risk does go up from a CD, which is paying 5% versus 12%. But the premium that you achieve above the risk-free, we're calling 5% risk-free because we're assuming the banks will for sure pay us that 5%, or if you're in a T-bill or something like that is the real equivalent, right, of that. It's like, okay, we know for sure, based on the faith of the government and the government to make the bond payments, that's a risk-free investment. But in order to take on a higher rate of risk, we need to be compensated with a higher rate of return. And what BD is saying is that we get a disproportionately higher rate of return for a relatively smaller amount of elevation of risk. Would that be a fair summation?
That's exactly the case. I mean, just like in a syndication in a multifamily, you'll be taking slightly more risk to get the higher level of return, right? To get the 15, 16% IRR. And when people kind of compare, they say, okay, let's compare all real estate investments. Where is the risk return level profile for a debt vehicle versus an equity vehicle? Now, equity vehicle might have a higher return in the back end, or higher overall return for the project, but it's considered higher risk. On the other hand, if you really look at a debt or a private note, it's actually lower return than an equity return, but it's actually lower risk because you're sitting lower in the capital stack. Your money is going to be paid out first. So every deal is going to be specific. But if you just say, hey, on average, if I'm getting on my private lending 12%, and maybe on my syndication I'm getting 20%, out in time, that's kind of the level of delta you want to be thinking about. Yeah, I could take a high risk, get into equity, and that's going to be back end loaded, lower cash flow upfront, but a much higher return. Or I can also diversify, take some chunk of money, put it into debt. I'm still getting double-digit return, 12, 13, 14%. And I'm a much lower position in terms of the capital stack. We're going to talk more about how do you assess that level of risk. But I'm still getting a decent IRR in terms of my return. I'm not getting 15, 16% IRR. I'm getting 12%, 13% IRR. And being at a lower risk point. So just a different avenue, a different way of allocation. And typically when you're looking at allocating money into real estate, which is something I'm heavily invested in, I look at these as completely different set of products. One is a debt vehicle and one is an equity vehicle. And I'd like to have both in my portfolio. One provide me that consistent fixed income growth. The other one provide me some smaller cash flow, but then, I would say the big equity jump typically is the end.
I love that. And I think that's something that a lot of our investors kind of lose sight of when they're looking at investments, right? Well, first, just to back that up a little bit, one point that you made. Right now's conditions really lends towards hard money lending because interest rates are so high. And as a result, hard money rates are going to be higher than when you go from a bank. And because of that, you're getting into double-digit returns on debt, which already puts us in a unique position because just 2 years ago, that was unheard of from a debt product. So, and there was probably less money going and less investor capital seeking private debt investments. Whereas now it's becoming much more lucrative, and it's almost a time that, hey, this is a really good time to shift into having these type of investments in my portfolio. The second point I want to talk about, BD, is that a lot of our investors, we look at IRR as in a vacuum, and that's the driving force of a decision on an investment. Like, hey, look, I don't invest in anything that doesn't at least have an 18% IRR, right? To me, that's a flawed way of thinking, because you can't look at IRR in a vacuum. You have to look at IRR relative to the risk that you're taking, right? And I talked about this on the live yesterday. I'm like, hey, look, there's a thing called Mega Millions. You can invest $2 and you have the chance to win $450 million. Now, the ROI, or the IRR projection for a Mega Millions ticket, is you can't get it. I don't even think that number fits on a calculator. But what you do, I guess it does, depending on the calculator, but if you do, but you have to look at it relative to the risk, right? So how likely is this going to happen that I'm going to receive this IRR? Now, what BD's saying is, like, if you're looking only, and you're just an IRR chaser, and you're only looking for investments that are only going to give me 18, 20%, and you only do higher risk investments, all equity investments, you may do very well. But you also are taking on a much higher risk position where you put your entire portfolio into only one type of investments, like private equity, and that's a riskier position in itself, right? So BD, what BD's saying, myself and BD, we were talking about this offline a little bit about wealthy people's asset allocation, right? Like, what do they invest in? What percentages go into what? There's a very high slice, especially in today's environment, where really savvy, sophisticated investors are moving higher percentages into private debt or hard money lending for that reason, right? Because it gives you diversification from equity investments. It gives you diversification from stocks. So number one, it's helping you diversify, which automatically lowers risk. It's also a lower risk investment than the syndicated investments that we talk about so much on this channel. They are lower risk, and because of that, they have slightly lower IRR. But don't get thrown off by the lower IRR, because a 12% IRR or 13% IRR that has a very high predictability of making it into your bank account, to me, gives me a lot more peace of mind than maybe a riskier, hey, development deal we're doing in this new market that we expect, we think things are going to happen, but we could think that you're going to get a 30% IRR. I mean, great, I got 30% IRR, sounds fantastic. But I don't mind to have some exposure at the 12% that I know that I'm going to much higher predictability of outcome, that I'm going to achieve that result. So don't be an IRR chaser is my point here, right? Develop a strategy where you've really balanced risk with return. I'm not saying not to do these investments that you have potential to get 30% or 50% or 100% IRR. I'm not saying not to. I'm saying make sure that you put certain percentages of your pie into low risk, and then you do have a bucket, maybe a smaller percentage of your portfolio that goes into very high risk investments with high levels of return. But the point is, don't just go for IRR. Look for a diversified strategy. Look for mitigating risk, and also keep in mind that you have to think about risk relative to your IRR that you're projected. Sorry, BD, go ahead. Keep going here.
No, I would just love to build on exactly what you said, which is like, okay, how do we understand risk? What is risk, right? We are investors. Right now, we say, yeah, private money is definitely, investing in debt is a great thing to do. It has a good, but how do we really assess risk? So when you're really assessing risk, you have to understand, what is really the credit risk of the borrower, right? And I'm not saying we do that. We actually, professionals, that are in the lending business do that for us. But you have to understand the credit risk. You have to understand the market risk. You're lending out on $1 million on a property. You're not, that they're going to be buying for $1 million. That's not smart, right? You want to be lending out 70% the value of that property, right? So you can build up a little bit of buffer. They come in, they put in the 30% down payment, you're lending them 70%. So that reduces the risk. So how much you're lending. So there's a lot of aspect that goes, so hey, if the market shifts, you're still protected because you're at 70% leverage or 60% leverage. So the lower that leverage point is, you're reducing the risk in terms of market volatility. And then the last one is like liquidity risk. Liquidity risk is like, hey, in the case the borrower did not commit to servicing the note, meaning they stopped paying on their mortgage, how easy it is for me to take over that property, and do I have the expertise to really sell it at a distress or whatever it is, so I can actually get my money back. So a lot of those factors go into that. And investors don't have to be experts in all of these areas, but that's why you would go work with a hard money lender or a debt fund, which is kind of the area we prefer is more where they go look at all these loans, they secure the loans, they take our capital and they invest it on our behalf to pretty much into, like I call it, the more secure vehicle to achieve that double-digit return for us. So when you're looking about risk, yeah, there's definitely the credit risk, there's the market risk, so there's credit risk and then the liquidity risk, how easy it is to actually turn your investment back to liquid so you can actually recoup back your invested capital if things go sideways, basically.
Great, yeah, that's awesome. I think you kind of segued into the next section here, which is the last section on this video, is that right? How do we get involved with these deals? Okay, so now we're interested, right? What we've been talking about on this video has piqued the interest and curiosity of the viewer, and they're like, hey, look, what they're saying makes sense. How do I get involved? How do I go and invest in debt, right? Like, well, how do I add this to my investment portfolio?
Indeed. So, I mean, for me personally, as well as a lot of investors, I'm recommending to allocate about 20%, allocation into debt to mainly diversify out of the stock market. So before I say how do we invest, we say, okay, what type of money we want to invest first. So for me personally, I like to take money from the 401k and take a chunk of that out of the stock market and move it into debt. And that's, there's a lot of, retirement vehicles that allow you to do that. So, instead of investing your own cash, which you can, for me, what I've done is I've taken allocation for my retirement because it has a better tax consequences that I'll cover in a little bit. But in terms of how you would do it, you can always find a sponsor or hard money lender that's going to lend out on one specific property. So you're providing them the capital, they're finding a property, they're lending out on that property, they're underwriting the loan, they're taking their own cut to do that, and then pretty much you become the first lien holder in that property. That's, I would say, it's slightly higher risk because you're really dealing with one property, one underwriter, one borrower. Then there's the more sophisticated way of doing it, is how could I do it across a portfolio of property across several lenders, and that's really kind of what pushes you more into what I call a debt fund. So just like we have sponsors on the equity side for syndications, there are sponsors that actually have their debt fund, and effectively we become investor in their debt fund. We take an allocation, and they have a buy box criteria in terms of the type of debt they invest in. They say, hey, we only do 60% loan to value on all our loans. We only do short-term loans, bridge loans, because those are the ones that tend to be higher interest rates that are between 3 months and 12 months. So you know that the period of the lending is. We only do loans that are that basically the borrower has the personal guarantee, that provided personal guarantee with a higher credit score. So they go and pretty much define, hey, here is the type of window and the type of people and the type of assets that we would lend to. We invest into their debt fund, and the debt fund would actually underwrite the loans. And then there's actually a preferred rate of return and then a waterfall split in terms of the capital that's generated after they take their fees, where we enjoy the high return and our benefit interest is aligned. So very much like a syndication, we're getting a preferred return on your capital and a waterfall split, like a 50-50 split or an 80-20 split. We work with various different debt funds that we like what their buy box criteria is in terms of lending. That issue debt for the different properties for the different borrowers effectively. So now our capital is not just one lien position against one property, against one borrower. It's many different lien positions across all the different assets in the portfolio. So from my standpoint, the way to reduce the credit risk, market risk, all the other risks that we talked about, and still get a high return is to go into a debt fund vehicle. And now there's diversification naturally within the debt fund because there's different borrowers, different assets, different loans, and they're constantly basically churning the debt. These are all short-term debts. And for us, we actually have the benefit of diversification and the high return that's being driven by a professional.
Great. So you basically broadly categorized this debt funds or hard money lending. And I've seen in other Facebook groups that they do this. So you can either invest in individual deals, right? And I actually seen in the other Facebook group where guys are actually putting out ads and say, hey, look, I lend money to flippers and et cetera. And, they can reach out to the dentist directly. And, the dentist can vet that person, ask them all the questions they think is important for them, all the background checks, their history of flipping houses, et cetera. You could do that, right? But that involves a much higher level of risk, as B was saying. And number two, you've taken on a lot of that due diligence risk onto yourself. And, unless you're a professional flipper, you've done this for a while, you're in a riskier position. I'm not saying that can't be done, because there are doctors that are hard money lenders, and they lend to, they know what they know what to look for. They know what they're doing when they look at properties. They understand the underlying value of the real estate in that particular market, and they can make an educated decision on making a loan. But that's one way to do it. But the other way is what BD was talking about, is investing in a debt fund. This debt fund is very much like when we're investing, and the principles that are involved are very much like the same principles we use when we're investing in an apartment building, right? Like a multifamily deal. It comes, the level of risk comes down to who is that sponsor? Who is the team, people that are running this fund, running that apartment building, right? That is where, that's the most important part. The who, not the what, right? So who is running this fund and doing the proper due diligence? Are these people capable of creating this fund and going out and lending the money and making sure that they get it back, and are they capable of executing, right? That's really what us as an investor is looking for. And now we're not directly responsible. We get to extricate ourselves from that part of, hey, finding the guys that want to borrow, and then vetting them, and vetting the deal, and vetting the market, and knowing what you're supposed to look for before making that decision. Now, if you defer that to experts, and they've clearly defined what they're going to lend on. Hey, we're only lending on single-family houses in the Dallas market that are priced between $300,000 and $500,000, 3-bedroom, whatever it is. They're going to be very narrow, very, very focused in their lending, because that's the areas where they're most experts, their level of expertise lies, and that's what they're going to lend in. And then we'll look at, hey, look, have you done this before? Hey, look, yeah, we've lent millions of dollars for 20 years, and we've received X amount of return for our investors. We have tons of references, right? This is what we're, and for me, I'm much more secure, BD, as a doctor, to lend money in a situation like that than it is for me to go and try to find it and try to figure out, like, hey, is this guy actually trying to scam me? Is this guy one of those guys that's going to take my money and run? I mean, I don't have time to go chase him and go find an attorney and all of these things. You can avoid all of that by finding the right sponsor, right company, and investing directly with them, just like we do in passive investing. As a passive investor, we are not trying to take on another job. We're not trying to learn another career. We are trying to defer that to the expertise of others so that we can make our money grow for us in our portfolios. And so I think that this investing in a debt fund, like you says, makes all the sense in the world for, busy professionals that are trying to get involved, that are trying to have this type of asset in their portfolio. Now, BD, let's kind of start landing the plane here. Roughly, what percentage of a dentist's investment portfolio should go into this type of investment, like private debt? Should it be a 5%, 10%? I mean, it obviously depends on the doctor, where they are in their career, where they are in their their finances. But roughly speaking, I mean, like if a doctor's like, hey, look, I have $300,000, I have $200,000 a year that I want to put into passive investments, right? Like I have a lot of investors that are like that. Hey, look, through my job, I can invest, $100,000 to $300,000 in your deals per year. That's kind of where I'm at. Now, if you're an investor that has $200,000 per year to invest in alternatives, what would you do, BD? Would you do, 100,000 into, maybe into a normal syndication, like an apartment building, and put 100,000 into hard money? Would it be more like 60-40, 20%? Is there a hard and fast rule? Just give me some of your thoughts. For a doctor that has $200,000 a year to invest, I mean, what do you think? Well, what kind of percentage should go towards a hard money lending?
Yeah, no, I mean, there's really no science to it. It's really right now, I believe there's a unique opportunity where I've actually upped the amount of capital we have in what we call like a fixed income vehicle. So we look at a hard money from an asset allocation perspective. It's a fixed income vehicle because effectively we are getting checks, continuous checks every month. So it's really fixed income. The yield is already determined. Once you're into that debt vehicle, you already know what are your checks that are coming. So we look at it more as a fixed vehicle. Now, it doesn't matter. It could be in your retirement account. It's still a fixed income by the type of class of an investment. It's not a lot of projected return or projected appreciation. Where the current market is right now, with the yields being high, with volatility in the stock market, with a lot of uncertainty and some distress in real estate or other areas, I've actually upped the amount of allocation that I personally have into a fixed income bucket. Mainly, I mean, I'm still bullish on terms of investing in syndication, especially new deals with a lot of distress coming into them, and you're buying them at a 30% discount, just like that deal we've done, a few months back.
Dallas, yeah.
So that's more like this is the big swing play where you're getting that big appreciation over time. But I also want to have that consistent train that is consistently producing return at a double-digit rate, especially in my retirement portfolio. Especially when I've seen that the stock market has gone up significantly. I know there will be a correction coming up in the horizon. I want to take a chunk out of the stock market. So from my standpoint, I only allocated at this point 20% of my overall portfolio in public equities, and everything else have gone into alternatives, whether it's syndication or debt. So personally, for me, I've allocated about 20% of my holding into what I call fixed income products, where debt in real estate or debt funds could be the type of products we're talking about. But different people are doing 10%, but I'm quite bullish on this strategy. And the flexibility of being into a debt fund, you can always call in the capital. Whenever you're seeing, hey, the level of return is not where you want it to be, you call in the capital. As these properties liquidate, they're actually returning back the capital. So from my standpoint, I believe 10 to 20%, depending on where each person lie in terms of their overall investing capital they want to put in, it's good to put into a fixed income vehicle.
Makes
the
sense.
reason,
That's
the reason I want to choose more the retirement accounts is just to the point I was trying to make earlier, is the tax treatment. Unlike real estate equity investing, where the cash flow that you have could get offset by depreciation, when you're investing into debt, that actually comes back as ordinary income. So that's no different than W-2 income. So that's the part of the reason why I like to invest into debt, into 401k. So if your dentist might have a defined benefit plan, or all these tax sheltered vehicles, these are great vehicles, for example, to diversify out of the stock market and start pouring into money into debt. So you'll be sending larger checks. This is not like a 100k investment, or you could allocate a 500k allocation into a debt. And the nice thing is it'll be broken down across several different properties, right? So it's not just you're investing a large check into one property, but you think about it more as allocation and really diversifying some capital within their retirement into a fixed income product that offer a high double-digit return at a fairly low risk.
Yeah, the tax part of it, right? And this is the last thing we're gonna, before we end this video, but the tax part is very important. I hope you guys took note of what BD said there. The income from these debt, and this might be considered a disadvantage by some, is that the income produced from these type of debt funds, it's ordinary income, right? And as us as very high income earning doctors, the last thing we want to do is increase our taxable income. So what BD's saying is that this type of asset is excellent to invest with retirement dollars, because you're not paying taxes on the gains, right? So you're not getting paid. So if you've invested, say, hey, I got $500,000, I got $1 million in my 401k plan, and I know that the stock market, and this is also what BD touched on, is at all-time high valuations based on hype, and we expect the stock market to correct. Well, this is a great time before that correction happens and stocks are at all-time high, is moving an allocation of that into these debt funds. And then the advantage of that, you're using and you can use 401k money by rolling into a different type of retirement vehicle, like a self-directed IRA or a qualified retirement plan. And by doing that, you have the ability to invest in types of things like debt funds, right? And the advantages of investing retirement dollars is that the proceeds from these debt funds that are coming back to you are going back into your retirement account tax-free. And this allows you to take advantage of compounding, and because now, once you've that income from the debt fund has built up in your retirement account, you can now go and redeploy into another investment, right? And that's where really the magic of compounding starts to happen. So I think that this is, and because of where we are in the market cycle, today's time period, current times, high interest rate times, this is the ideal time to start really strongly moving percentages or slices of your allocation into debt funds. All right, guys, I hope that this video helped. BD, I want to thank you once again for being here and sharing your wisdom and insights with us on our channel. We are very, very appreciative of you. And if you want to see more of myself and BD, we're going to be at the Passive Investing for Dentists Summit. The link should be in the description below. We're limiting it only to 50 people. It's going to be a small, intimate event where you get to really know the speakers and each other. And I can guarantee you that it's going to be packed with value that will supercharge your retirement portfolios and really up your cash flows from bank accounts. BD, any parting words before we end today's video?
No, Dr. Johnny, I appreciate the opportunity here to speak. I'm a full-time investor and I enjoy this topic, and I'm really looking forward for the August event. I think the amount of knowledge and being in these rooms where these discussions happen for me in the last 10 years had definitely elevated my investing game. So for a lot of a lot of your dentists and a lot of people that are watching this, I believe it's so much value to really invest in yourself and being in these rooms and networking with these people. Part of the way I've for example, uncover this whole debt. I've been looking for a debt vehicle for a while. Is you go to events and you go network, high net worth vehicles, family office events, and so forth to really understand, hey, how are people are really investing. So it was really after a family office event where I've spoken to many different investment experts, and they're all allocating into debt. It really opened my eyes, like, oh my God, we really need to kind of start shifting things and redeploying assets and allocation into debt. So I hope a lot of the listeners there get value on this and really opens their minds and expand their journey in terms of investing. So I appreciate everything you do for this channel and for a lot of the followers. And thanks for the opportunity to be here.
Thanks again, BD. All right, guys, for more wealth building tips and videos, click on the link for the next video, and I'll see you next time.